Now, 1 month after its commencement, the Naira for dollar policy by the Central Bank of Nigeria has led to positive accretion to the FX reserve, which rose to $34.85 billion as of the 1st of April. As the first full trading week of the month winds down, Bankole Odusanya, the head of fixed income trading at UBA, joins me now for a recap of the trading week so far. Thank you so much for your time today, Bankole. But let's first start with the sentiments we've seen play out this week.
Thank you, Ken. The major highlights on the fixed income market this week has to do with the DMO simply just sticking to plan and highlighting that they will be raising about $6 billion from the Euro bonds market and that the process has been kicked off. They had been quiet in the first quarter, but if you see the trend with stop rates and yields of the bond market, you will find that it's becoming too expensive for the debt management office to keep up with cost of debt service. I mean, historically also there's been complaint about cost of debt service to revenue. So right now I believe they're trying to, diversify their source of funding this time around and try to see if they could raise about $6 billion at single digit. We've seen First Bank and EcoBank raise at 7% and 8% respectively. It depends on the tenor, and then, being a sovereign, they could raise huge funds at those levels also, single digit basically.
All right, but how has the market reacted to that news of the planned issuance of the Eurobonds?
Prices oscillated. We saw yields going up before and prices dropping. But what has happened is that people who probably had intention of going short will probably be reconsidering that situation right now because supply won't be much at the next auction. I mean, this calendar, even though they have said they will be raising about between 150 to 180 billion every month, the DMOs could simply just come to sell 120 billion. I mean, in trying to manage their costs. And so that could just be counterproductive for the bearish traders right now. But one other key factor to look at is that there's not so much liquidity, and then few funds that will be going to these auctions will be asking for higher yields. And I mean, if the DMO were to be desperate to raise funds, they will be giving in at 12 and 13% levels. One other factor is that in May and June, there are no coupons. In April, between the 18th and the end of the month, we have about 190 billion coming in for coupons. Most of those funds will be, reinvested into that line of asset. And so we see some stability, bringing back demand from 18 to the end of the month. But during the auction, you see some sentiment from bearish traders who have gone short trying to cover. So we expect rates to stop at where it stopped close to where it stopped at the last auction. The dealers right now, I mean, it's cause for concern that the DMO will probably not sell as heavy as they did in the March auction where they sold 220 billion. They have put out an offer circular that is about 180 billion, and going forward, we expect them to try to, raise some funds outside of the FGN bond issuance cycle.
All right, then definitely liquidity is still an issue there, but what's the likely impact we're going to see play out in the bonds market there? We're looking at the second quarter calendar out already, but we're not seeing coupons and maturities in May and June.
Yeah, we expect yield expectations still remains high, given all the fundamentals we're seeing, the inflation, and then the need to raise fiscal fund revenue. And then, you can see that in this week, we've been seeing the government talk about increasing tax base and taxation itself because they have a lot of projects at hand. I mean, security issues, agri funding, and all sorts of social investments that they need to do to kickstart post-COVID kind of economic recovery. They need a lot of funds, and they'll be raising some by debt and trying to raise some by taxation. So basically what we are seeing is that the government may also be thinking of other sources by trying to get Eurobonds or foreign exchange debt this quarter as quick as possible in order to avert a situation where they have to give in to bids as high as 13.5 on the bonds auction. But basically illiquidity is what is also stifling the secondary market and then pushing yields up in the primary auctions.